I've been a professional investor for 18 years, from my first job on Wall Street to running an investment company here in Europe. And if I had to start over again from zero, this is what I'd do. Okay, so you're excited to start investing and make your money grow. You have financial goals like buying a house or working less or traveling more. Maybe you know somebody who retired at 50 and lives off their investment portfolio. But here in Europe, beginning investors face so many choices: stocks versus bonds versus ETFs. Investment apps like Trading 212 versus Revolut versus Trade Republic. What to do about taxes? It's all so confusing. So you give up and your money stays in your bank account where it loses value to inflation every day. Well, you can cut right through this confusion with what I call the Sybil framework. I have used this to help thousands of people all over Europe start investing. To explain the first step, imagine that you go to a restaurant with a group of friends. Would you simply order a big, bloody steak for everybody without checking who's vegetarian, who prefers beef or chicken or fish, and who's got allergies? Of course not. But for some reason, people seem to think the best investment for everybody in Europe is buying the S&P 500 or an all-world ETF like BWCE. Long before you jump to specific investments like this, you need to figure out step 1, strategy. And the first layer of your strategy is how to split your money between stocks and lower risk investments like bonds. Now, to figure this out, ask what is your main investment goal? Is it passive income or one big purchase? How many years are left until you start spending? And how much risk are you willing to take? For example, if you're young and investing for retirement, which is still 20, 30, 40 years away, you will probably want to invest 100% of your money into stocks. As you approach retirement, you might want to reduce the risk until you get to something like a 50-50 portfolio of stocks and bonds. And if you're saving for a big purchase, like buying a house, you might go even more conservative to reduce the risk that the market drops just when you need the money. The second layer of strategy is how exactly do you invest? Will you buy individual stocks, for example? This is a high-risk, high-reward activity because some stocks like Nvidia or Amazon can indeed turn $10,000 into $1 million over 10 or 20 years. But the average stock in the market actually ends up losing money. Or do you prefer a more reliable approach like investing in ETFs, which buy hundreds of different stocks around the world, and which are almost certain to be profitable over the long term? Now, if you decide to invest in stock ETFs, the next strategy layer is geography. A lot of European investors invest in US stocks using an index like the S&P 500. But today, with Trump's open hostility to the rest of the world, this could be a risky approach. Others invest in developed market indexes like the MSCI World, which offers more diversification, although as much as 70% of your money can still get invested in the US. Still, other investors prefer European stock indexes like MSCI Europe, or emerging markets indexes like the FTSE Emerging Index. There is no right or wrong answer here, as long as you pick a big global region with many countries, many industries, and many companies. And the final layer of strategy is broad versus targeted investing. The classic passive investing approach would be to pick a broad market ETF which invests in all different industries and different company sizes. But there are other strategies which have a good track record, such as small cap investing, or value investing, or momentum investing. With such strategies, you buy a fund that only selects stocks that fit particular criteria. That said, for most beginners, the broad market approach is probably the most reliable. Okay, so that's step 1, strategy. And only after you've decided on your strategy, you move on to step number 2, which is selecting specific instruments to buy. For example, let's say your strategy is to invest 100% in American stocks using ETFs. Which exact ETF should you use? A lot of people imagine, well, I'm just going to use the most popular one, SPY. But actually, if you go to your brokerage and try to buy SPY, you get denied. In most European countries, you can't buy this fund because it's legally established in America. Instead, you should go to justetf.com. So this is a big database of ETFs available to European investors. And if you want American ETFs, you can click on equity, so that means stocks. And under country, you simply select the United States. And that gives you 385 different ETFs to choose from. So as step 2 of the framework, select which instrument is right for you. I've actually got other videos on this channel where I deep dive into how you select funds on just ETFs, so I won't get into the details here. But I will say this, pay attention to at least 3 factors. First, costs. So you can look at the total expense ratio, the TER. Keep it as low as possible, because all else being equal, lower cost ETFs usually perform better. Second, size. You can see it over here in this column. Now, you don't need to have a huge ETF, but I generally prefer ETFs which have a size of at least 100 million euros. This gives the ETF a lower risk of getting shut down. Now, if an ETF gets shut down, it's not the end of the world, but it's a hassle. It can have tax consequences. So I prefer bigger, more established ETFs. And third, consider taxes. Make sure that the ETF you choose is a good fit for your country. Depending on your local tax rules, the best ETFs in Germany are not the best in Spain. Tax rules will determine whether you should prefer accumulating or distributing ETFs, Irish versus Luxembourg ETFs, physical versus synthetic ETFs. Now, I know that all this terminology can feel confusing at first, so if you'd like to shortcut this learning process, I'm going to share one way to do that in a second. But for now, let's move on to step 3 in the Sybil framework. The trouble is, if you want to buy a stock or ETF, you can't do it directly on the stock exchange. You need an intermediary called a brokerage. Think of a brokerage as a supermarket for investments, except with a regular supermarket, you buy some sugar and you bring it home. But if you buy a stock or ETF at a brokerage, the brokerage holds on to it for you. And that's why your first priority when picking a brokerage is always safety. Ask questions like, is this brokerage licensed in a European country? Does it publish financial reports and is it profitable? Does it have a good reputation? Or does a quick Google search reveal any scandals or problems? After looking at safety, the second factor to consider is fees. The less you pay your brokerage in fees, the more money stays in your account, so this is critical. Avoid brokerages that charge custody fees, which grow with your account size. The best brokerages today will only charge you a few euros every time you buy or sell a stock or ETF. Next up, you need to check product access so that you have a good selection of stocks and ETFs. Today, because of EU regulations, some brokerages offer a very limited selection of investments to investors in smaller European countries. So, for example, if you're based in Latvia or Lithuania or Slovenia, it could be hard to invest using brokerages like Saxo or N26. And then customer service is important because you need to be able to reach a live person if there are any issues with your account. Especially with fast-growing fintech brokerages, you often hear stories of accounts getting frozen because some algorithm decided that you look suspicious. If that happens to you, you need to be able to reach a real live person who can help. And of course, as always, taxes are a consideration here too. In some European countries, most prominently Germany and Austria and Denmark, it's important to have a local brokerage for tax reasons. There is no single best brokerage for everybody, but let me give you a few names to start your search. If you are a beginner and you want the simplest possible user experience, I would consider Trading 212 or Trade Republic or Lightyear. If you are looking for a more sophisticated brokerage with stronger financials and a longer track history, I would look at Interactive Brokers, Saxo or DeGiro. But before I reveal the next step of the Sybil framework, which is where your money actually starts growing, here's an idea. If you want to save yourself a lot of time and effort going through these steps and learning all the skills you need, I run an investment training program for Europeans called the Index Masterclass. You can find out more by following the first link in the description. Okay, so here's step 4, and it's one that people often overlook because they imagine that once you select a stock or ETF, you simply type in the name in a brokerage search box and click buy. But actually, here in Europe, it can be a little more complicated than that. For example, let's go to Trading 212, and let me look up a really popular S&P 500 ETF, like the iShares Core S&P 500 ETF, okay? Immediately, I see that I can buy this ETF in euros, in pounds, in dollars. I can buy it on the German Stock Exchange, the London Stock Exchange, on Euronext Amsterdam. I've got the accumulating version of the fund and I've got the distributing version. And then once I select the version, let's say the Euro version on the German Stock Exchange, you can choose between multiple order types, like a market order or a limit order. Now, I usually train people to use limit orders. That's how you can make sure you get the best possible price. But in many cases, a simple market order can also be fine, where you simply tell the brokerage, buy one share at the latest available price, and that's it. So these are the skills to master at step 4, which stands for invest. But quite possibly the most important step in the Sybil framework is the last one. It's also the step people overlook most often. To master this last step, you need to answer the following questions. First, how often do I put money into my portfolio? Once a month? Once a quarter? Once a year? Well, the answer depends on a number of factors, but for most investors, once a month or once a quarter are both fine. Second, when do I change my portfolio and when do I leave it alone? Well, it's often so very tempting to start messing with your portfolio when you see some exciting news headlines about Donald Trump saying something crazy, or a new AI technology coming out, or some geopolitical problems. But decades and decades of evidence say the same thing. People are really bad at reacting to news. Most of the time, we mistime the market. We buy and sell at exactly the wrong time, and we just mess everything up. So the short, evidence-backed answer is leave your portfolio alone as much as possible. Now, the third question is, when do you start taking out money? And how much money can you afford to take out? So if you're using your portfolio for passive income in retirement, this is really important because you want to spend as much as possible without running out of money. Many people online talk about the 4% rule. Every year, take out 4% of what your portfolio was worth at the time of retirement, plus you can increase this amount by inflation every year. Now, there is some evidence to back this up, but other experts, looking at the broader set of data, suggest that this is too aggressive, that a safe withdrawal rate is actually just 3% of your portfolio. But then on the other side, you've got people who say, well, you can actually take out more than 4%, as long as you're able to reduce your spending if the market falls. So this is an individual decision. You have to weigh the risk of running out of money versus your need to be spending today. My personal view is that the 4% rule is a good start. It's an easy way to start planning, especially when retirement is still a ways away. And then when you get closer to retirement, you need to look at the entire picture, okay? Do you have a government pension? Do you have any other assets? Do you own your own home? What portfolio do you have? And then you can decide if you are comfortable taking out 4 or even 5% per year, or if you need to be more careful and take out less. But as you can see, there are quite a few questions that you need to answer about long-term investing. And that's the last step to master in the Sybil framework. Now, to be honest, putting this framework into practice can be a little bit time-consuming for beginners. To set up a great investment portfolio, you need to choose from thousands of different ETFs. You have to find a brokerage that you can trust, and it takes time to investigate the local tax rules in your country. So if you'd like to shortcut this process, I've got a step-by-step training that you might enjoy. Just follow the first link in the description.